Hi there, my name is Andrew Macken and welcome to this week's edition of Video Insight. Today I'm going to discuss the topic of do-it-yourself or DIY investing. Many Australians like to invest directly into the stock market themselves, not only through retail brokerage accounts that many of us hold, but increasingly through self-managed super funds. Consider that of the approximately $1.9 trillion of Australian superannuation assets, around $600 billion are controlled by around 535,000 self-managed super funds. For a great deal of these self-managed super funds, the individual manager is directly picking stocks in the share market themselves. Now, there is certainly nothing wrong with this, and for sure there are some benefits to DIY investing, such as knowing exactly which stocks you hold and when you hold them, not to mention our nation's cultural love for a good punt in general. But there are certainly some drawbacks to doing it all yourself. Consider the following. Let's say you manage a portfolio of 20 to 30 stocks, and then at each reporting season, like the one that recently finished, you will need to read a results filing that averages around 100 pages and an investor presentation that averages around 50 pages for each stock. That equates to between 3,000 and 4,500 pages. You will also need to listen to 20 to 30 conference calls that last around an hour each. And this is just to get up to date for the stocks that you already own. This does not include the time required to research any new potential stocks you are considering buying. The next aspect is one of interpretability. Assuming you do have time to read the thousands of pages of company filings just mentioned, you need to be able to extract a level of meaning out of these filings that is somewhat unique to everyone else in the marketplace. As we have discussed on this blog in the past, you can only outperform the market if you have a perception about your investment that is different to others in the marketplace, and you need to be right. If you merely hold the same views as those being implied by the market, then by definition, you will not outperform the market. Extracting unique insights out of company filings is by no means a trivial task, especially for an individual investor. Remember, given the need to diversify, the 20 to 30 stocks in your portfolio will be in companies that span across multiple industries. It is quite rare for an individual investor to be as proficient in, say, banking and insurance company analysis as they are in, say, mining and healthcare. And you are effectively competing against institutional investing teams that hire specialists in each of these fields, and they're working full-time every day to extract unique insights out of these company filings and other sources of information. So to summarise, DIY investing does have some benefits around control and transparency, and it can certainly be fun, but it can also be an expensive hobby. Remember, when you are the buyer of a stock, you are implicitly saying that you have more insight about that stock than the seller. You need to be able to articulate why this might be true. That's all we have time for today. Don't forget to follow us on Facebook and Twitter.